Wow, that was kind of annoying. So the so today for Integrity Capital Education, I'm going to spend some time talking about receiving fees from lenders. This actually came up with Tom, I think last week or something, so I thought it'd be just really important for us to broach this topic today, because I think it matters. And so let me just start off by answering the question, what do we mean by that? Receiving fees from lenders. So for the loan associate, you go through all this work and then you get to the place where you're going to start talking about fees, how we're getting paid. I guess that's the simple thing is, people are always kind of going like, how are you, how do you make money, doing this? Obviously we're not a nonprofit, right? So we're charging a fee for the service that we're providing, which is the proactive commercial mortgage services. And so there's really two ways that you'll see within this industry that people get compensated. They'll get paid just by negotiating a fee with the borrower, or they'll get compensated by the lender. Okay, so there's, or a combination of the two, but those are primarily the two ways in which people are compensated by negotiating a fee with those parties. If we want to talk about standard industry or what's norm for a traditional loan, I'm not even talking about hard, traditional loan is usually 1% to 1.5%. It's kind of in that range for the percentage of the loan amount is what we get compensated on. Okay. It's not the purchase price, but it's the loan amount. And, for hard money or private money, it's usually 2 to 3 points off of the loan amount. They're usually harder loans to do, but that's what we mean by, obtaining a fee. That's what we're talking about in getting compensated. So for those of you who might be newer or whatever, just any questions or clarity around that? Michaela, do you have any questions, or even Lana? Does that all make sense?
Mm-hmm.
No, yeah, that makes sense.
Okay, good. So so then the second question is, why the heck are we having this conversation? And because here's why. So you kind of always pull back to making decisions based upon your value system, right? So, or lack thereof. But we all are making decisions every day based on some value system. So for us, we made a choice corporately to say, because one of our core convictions is, the Christ model of others more important, we felt like we could tangibly manifest that to the client by not doing anything that would be underhanded or not fiduciary to them or not beneficial to them in any way. Okay. And so when you look at this industry, and those of you who've been here for a while can kind of attest to this, in our industry, specifically commercial mortgage finance brokers, 99% of them operate under the guise that it's totally fine for them to jack the pricing up of the interest rate so that they can receive a fee on the back end. Okay. And the borrower honestly never knows about it. It's pretty seamless. So you kind of go, no harm, no foul, right? Getting paid, the borrower doesn't know about it. Here's why we have a problem with that. And then we're going to get into some of the nuances. In theory, if we're representing the client and our attitude is the Christ, we want to do what's really in your best interest. then if I'm getting paid to increase the interest rate that the client has no idea, and then I'm getting compensated for that, the challenge is that the motive could be really impure, that you didn't really move the client to where the best loan was for them, but you moved them where you felt like you were going to make the most money. And so your motives, again, not that we don't need to make money, but I think there's just a right way and probably a wrong way, at least from our, sort of value system, that we don't want to do that. Because if I'm the person on the other side of the coin and I'm going to someone to represent me and have my best interest in mind, and I find out that they increased, so I have to pay this for the next 10 years, and my interest rate just went up 25 basis points, it's a lot of money, and I'm paying for that at your expense or my expense. You're getting benefit at my expense, and there's no really tangible benefit. I could have, had a lower interest rate and, essentially, not done that. And the other part that's disconcerting for us is that it just seems like there's an underhanded, like, you don't know what's going on. I'm doing something that you have no idea what's going on behind the scenes that I'm getting paid for. It just, something about that just sniffs like it's not above board, right? That we're not really being a fiduciary. We're not really being transparent. That we're really not being proactive other than aligning our pocketbooks, in that instance. So I'm a big believer in making money and making good money. There's nothing wrong with that. I just say, let's do it the right way. Let's do it above board. Let's do it where we're adding value and there is truly an intrinsic benefit, right? So does that make sense? Are you guys following me on that so far?
Yeah.
Yes.
Okay. Do you agree with it? I guess that's probably another question too. Or
Yeah.
Yes.
No, yeah, definitely. Yeah, it makes sense.
Definitely.
Much more transparent for the client to understand the fee he's paying either way.
Yeah.
Yeah.
Correct. Let's walk through a couple of scenarios because let's put some legs to it and have something specific. Because for us, specific is what?
Terrific.
There it is.
Hey.
Vague is the plague, right? Good job. Lana's I've got like a sticker chart over here, Lana. Sticker.
Probably running out of room, right?
Gold stars.
Pack the smiley faces. So let's walk through a couple scenarios to give you guys something tangible. So scenario one, lender increases the spread to pay us a fee, right? Just pretty simple. Client doesn't know about it, increase the fee. Pretty straightforward. It's a no, right? We just, and that's always the question we want to ask the lender. Hey, we can give you some yield spread premium. That's kind of the terminology, yield spread premium, YSP, to pay you. Well, the immediate question you ask is what?
How is that impacting the borrowers? How much of I mean, if they're bumping up by a quarter or even any amount, it's impacting them, but it's kind of an unknown impact.
Right. So you're asking them, well, what does that mean with respect to the interest rate? Did you just increase the interest rate to pay me? Right? Did you just increase the spread to pay me? Or are you just paying us and everything stays the same whether I got it or not? Right? That's a really important question to ask because they have different sort of things. So client gets hit, I get paid, or is it all the same? You guys are the ones paying me out of your own compensation. Okay. Very different because in that particular instance, we're not, essentially, it's just kind of different scenario. They don't know about it. We're increasing rate, getting paid, or nothing's happening. and getting paid. So that's the first scenario. If they say they're doing it, it's a no automatically. Okay. So client would rather, here's another scenario. We've actually had this happen, Lana, you remember with Andy. Client would rather have us increase the rate and then pay us. Okay, so it's above board. You're saying, hey, look, if you want, I can have the lender pay us if this is a challenge, and we'll just increase the rate. You know about it. It was above board. It was transparent, and and we all kind of move forward. That's a yes, right? I mean, we can do that, and that's not a problem at all. So that would be a scenario, and it has happened, might happen in the future. If you're negotiating with a borrower and they're, I don't want to pay your fee, and that could be a tactic that you could use to say, well, let me see if I can find out if the lender could, sort of, pay a fee, and we can work something out. Okay, so that is a possibility. That is a likely scenario. I shouldn't say likely. Could happen. Probably not that likely, but it is. The third scenario, which is lender will not increase the rate to pay us a fee, but will pay us. Okay, so kind of like I talked about earlier, they're not going to increase the fee. They're going to pay us. So should we do it? Should we do it? And I would argue, yes, possibly. Okay, it sort of depends. There does come a judgment call where you have to kind of make a decision. Is this excessive? Am I getting greedy here? Am I being a little overzealous on this? And all of a sudden I'm, making a huge thing here, and the client's not paying for it. So I think there's a little bit of judgment call in that you're going to have to. And so I'm going to walk you through a couple of different scenarios as well. So that is one potential scenario that could happen, and you have to make a judgment call on that. I'm not saying it's out of bounds, but I think it could be. And I think that's probably one of those question marks you might want to ask your manager and kind of go, hey, here's what's going on. What do you think? And we just walk through that and make a judgment call. But I think some of that ends up being, does this seem excessive or not for what we're doing? Okay, so that could be part of the decision making. Should we charge a fee to the borrower on top of this? So that's the question. So okay, so they're not going to charge the increase of the rate. They're going to pay us a fee. So now the question is, do we still charge the borrower a fee? Okay, so that's the question. And here's probably a structure that you can think through when you're making this choice. It depends. And my first one is if it's a small loan or just a small fee. So if we have a small fee, then that could be a potential yes on that scenario, because we spend a lot of time. It's a lot of investment that goes into this. Break even for us, honestly, is probably around $8,500 per transaction. I mean, there's just a lot of time, a lot of costs, a lot of stuff that goes into it. So you start to fall into that small, and you go, David, what's small? Well, honestly, if you're $1 million to $2 million, that's not a large loan. It's not a large fee. That's where you start to maybe kind of go, okay, I'm not giving you black and white, but I'm leaning this direction with some additional counsel, right, based upon that. So I'm going to hit the pause there for a minute. Any thoughts, questions, feedback, clarity on that?
I have a question. So there's two options from what I'm understanding, is the borrower pays the fee or the lender pays the fee, right?
Right.
So what is it just the way the structure's built out or what makes that determination of who pays? Is that a negotiation factor?
Yeah, that's a great question. There's a couple of elements to those scenarios that will happen. 9 times out of 10, it's not going to be with a bank, meaning, a local community bank's never going to pay, fees to a borrower unless it's an SBA. So SBA lenders sometimes will, sometimes won't. So the first scenario for that, Lana, is it depends on the institution, because some institutions just don't pay fees, period. Okay. And almost all of them, if it's a bank, don't pay fees on conventional loans. If they're SBA, 7A loans, it's probably 50-50, 40-30. It just depends. Some do, some don't. So the first thing is, depends on what the lender is and what you're doing. Fannie, Freddie, they pay fees almost all the time. Okay. So that's the first element of the context, and so that would be the first piece. So if they pay, then it's a matter of, the negotiation. That's the second piece, right? So the negotiation is, we know that if they jack the rate up, it's a no for us. They don't jack the rate up. That's where we start walking through these scenarios of whether we're going to get compensated or not. Does that make sense?
Yes, so basically, when we're doing a transition call, if I hear the bank's paying us, so for processing, we would send our invoice directly to the bank, or I think I've only had one of these.
Yeah.
And I was still kind of confused. Maybe on one of Tom's deals, I was confused because I'm like, okay, the bank's paying us, and I don't. But the borrowers, I got really confused. I don't remember what the outcome was. I know it
Well,
worked out. But
That was a SBA 504 deal where on some of our deals, the fee can be paid by the lender through escrow, but it's still the client paying it. It's just that the lender is basically financing the fee for the client, so they don't have to come out of pocket, which is a different scenario. It's not the lender on the 504 deals, they can cover part of it instead of the client having to come out of pocket on all of it.
okay. But would processing be the same as far as like submitting invoice and things
Yeah.
of that nature?
No, that's a good question. I would say that we can we can build out protocol on this, but I would say protocol is first step always is, which should already be in your process, which is getting clarity up front at the transition call as to who's getting
Mhm.
paid, how are you getting paid, so that should all get clarified there. So you kind of know, like, we're getting paid by the bank or by the borrower or both, right? And then that will be the starting place, is just the clarity as to how we're getting paid and through who.
Mhm.
And then the second component of that is, if you are getting paid by the bank, then it could be a couple scenarios, which are either A, they just tell us to send them an invoice, or B, they want us to fill out some paperwork, right? And then that paperwork needs to be filled out to get paid. Okay. So those are probably the two scenarios of sending an invoice, filling out some paperwork to be compensated from them. If that does that make sense?
Yeah. Mhm.
Yeah. So just say you get clarity in the transition, and then you'll have like paperwork and things like that you'll submit to the lender. So if you don't have clarity, right? Remember, Fort Knox is the transition call, right? So if you don't if you don't have it clarified, then you really need to hit the pause button until you do, kind of thing.
Mhm.
Is that helpful?
Yes.
Okay, good. So basically, again, the small fee could be a scenario. Are you tracking with this, by the way, Michaela? I know you're newer, so I don't want to.
Yeah, no, definitely. And the more you talk about it, the more it makes sense. So
Okay, all right. I just don't want to rush it. So I'm glad you're asking questions, you guys. So I want to walk through these things with you. So again, the lender not increasing the interest rate, but paying a fee scenario would be small, possibly yes. Double check with your manager. Construction project, I would almost say yes automatically. Assuming that we can. I don't know if that will happen or not, but I would almost say yes. And I'll tell you why. Tom and I tracked this years ago. It's almost double the time to do a construction loan. So that to me is pretty easy. There's just so much more involved in a construction project. There's so much more time involved, more manpower, and so we're almost doubling the amount of time. And so that to me is a pretty easy answer of a yes. That if that scenario happens, I think it's completely valid, ethical to allow that to happen because of the amount of time involvement. The third one, which could be a little bit gray, which I think again we'll go back to the first one, is you're going to use some judgment and then you're going to confirm it with the manager, is if it's a complicated transaction. Okay. There's a lot of moving parts and ton of entities, and there's just some complexity to the transaction and nuances and things that are going to be. I mean, Lana and I just got done doing one of these with a land deal we closed, and there was just guy had I think he had 30 attorneys, and so that alone was difficult to try to figure out. But so if it's really complicated, then I'd probably say the same thing. Probably yes, because it's just more involvement, more time, more manpower. It seems to me that would be the likelihood. Again, this isn't black and white when we get to this section. Some of it is, right? If they increase the fee, if they increase the rate to pay his fee, the answer is always no, right? Unless the borrower knows and says, that's what I want, right? But the rest of it, there's a little bit of gray there to use some judgment to make a decision, and then you kind of codify that with your manager type of thing. So, I think, I wanted to go through this with you guys again. I know some of these things might seem like they're a little, tedious or, nuanced, but it's important because all this stuff comes into play under the bigger thing we're doing, which is, to be the most proactive commercial mortgage company in the world, is because this is just another way we are proactive, because the reason why is, remember, part of proactiveness is to giving clients confidence of execution. And part of that is peace of mind. So I would have a lot of peace of mind if I know this person really has my best interest in mind, right? And so, that's why it's so important for us to do this. We want to serve people. We want to do well, but we want to serve them well. And so, it's just important that we do so above board, doing things straightforward, and not getting into some, and not to mention, by the way, I'm convinced of this. All these people that are charging this back end pricing, one day that's probably honestly going to come back and bite them in the butt. If I'm just thinking legally, that's the exact reason we didn't get into the PPP loans. Everybody did. I just saw that and I was like, red flag, like lawsuits waiting to happen. And so it's just, you can sort of sleep well at night and go, okay, don't have to worry about somebody coming back, suing me, going, hey, I didn't know you jacked the rate up and, blah, blah, blah. So just, from a stewardship perspective, it's also wise, So what do we do from here? Use this as a model, okay? Should give you some confidence and clarity on, processes and protocol. And then if you're not sure, ask your manager. Okay, that's kind of your fallback is just if you're not quite sure, ask a manager. And then, you should be able to get the answer that you need to. And then Lana, in terms of the protocol, if you want to offline tighten that up at all with me, I'm happy to do it. So.
Okay.
So that is our education for